They opened 5 stores every single day. They raised $600 million on Wall Street before their second birthday. The stock surged 50%, and investors called it China's Starbucks killer. 23 months to a $5 billion valuation. Then, an anonymous whistleblower exposed them. 13 months after the IPO, the company was delisted, bankrupt, and caught fabricating $300 million in fake sales. This is Luckin Coffee, and this is how they fool the world. June 2017, Jenny Qian walks out of China's biggest ride-hailing company with a question. If apps can disrupt taxis, why not coffee? She's watching Starbucks charge $5 for lattes while Chinese consumers are discovering coffee culture. Her pitch is simple. Make it faster, cheaper, and 100% digital. Luckin Coffee launches with backing from billionaire Charles Liu. No cash registers. No lines, order on your phone, pick up in 30 seconds, pay half what Starbucks charges. Every transaction flows through the app. The growth is insane. Within 18 months, Luckin opens over 2,300 stores across 28 Chinese cities, 5.2 new stores every single day. Starbucks took decades to build that presence. Luckin does it in a year and a half. By late 2019, they're serving 17 million customers and pouring 111 million cups of coffee. Founder Jenny Qian promises to surpass Starbucks in China by 2021 with 10,000 stores. The media eats it up. Tech meets coffee. David versus Goliath. Then comes Wall Street. May 2019, Luckin prices its IPO at $17 and raises over $645 million, just 23 months after founding. The stock explodes 50% on day one before settling up 20%. Valuation: $4.8 billion. Investors are euphoric. This is the next tech unicorn. Jenny Qian appears on magazine covers. Analysts publish glowing reports. Nobody's asking hard questions because when stocks go up, questions feel like pessimism. But here's what nobody wanted to see. Luckin was bleeding cash. First quarter 2019, right before the IPO, they lost $82 million on just $71 million in revenue. They were losing more than they made. From 2017 to early 2019, Luckin burned through $479 million. If you're already seeing the red flags, drop a like. This gets worse. From April 2019 through January 2020, Luckin Coffee fabricated sales, over $300 million in fake transactions, 45% of their reported quarterly revenue. Almost half was fiction. The scheme had 3 parts. Employees and family members bought coupons using company money, then redeemed them for fake sales. Shell companies created bulk orders that never happened. Related parties ran fake transactions through the app. Every fake sale got recorded as real revenue. But faking revenue creates a problem. Your profit margins look insane. So Luckin fabricated $196 million in fake expenses to match the fake sales. They built a second operations database, one with real numbers for internal use, one with fake numbers for auditors. Bank records were altered. Accounting ledgers were doctored. While this happened, management was cashing out. Luckin's founders pledged 49% of their stock as collateral for personal loans. They were extracting cash while publicly promoting growth. Why? Because the business model didn't work. Luckin was burning over 1 billion RMB per year in operating cash flow. The discounts needed to attract customers made every cup unprofitable. If they admitted the model was broken, funding would stop. The stock would collapse. So they lied. They inflated sales by 69% in Q3 2019 and 88% in Q4. They told investors growth was real and profitability was coming. Wall Street believed them because the story was too good to question. January 31st, 2020. Short-selling firm Muddy Waters Research posts they've received an anonymous 89-page report alleging massive fraud at Luckin. The report includes 11,000 hours of store surveillance footage and analysis of 25,000 receipts proving stores were overstating sales by up to 88%. Muddy Waters announces they're shorting the stock. Luckin's shares dropped 10%. The company immediately denies it, calling the report misleading and false. Most investors assume it's just another short seller attack. But the report came from Hong Kong-based hedge fund Snow Lake Capital, who'd spent months gathering evidence. Store visits didn't match sales claims. Foot traffic analysis showed stores were empty while reporting record transactions. Luckin's auditors couldn't sign off on annual financials without investigating. For 2 months, Luckin maintained innocence publicly while an internal audit unfolded behind closed doors. Management kept promoting the growth story. The bomb was ticking. April 2, 2020, Luckin issues a press release that shocks Wall Street. Chief Operating Officer Jian Liu and several employees fabricated approximately $310 million in sales. The confession is public and devastating. Nearly half of reported revenue was fake. The stock collapses 79% in a single day. $5 billion in market value evaporates. CEO Jenny Qian and Chairman Charles Liu are removed immediately. 12 employees are terminated. June 2020, NASDAQ delists Luckin after just 13 months of trading. December 2020, the SEC imposes a $180 million penalty for defrauding investors. February 2021, Luckin files for Chapter 15 bankruptcy protection in U.S. courts. Investors who bought at the IPO lost over 93%. Thousands of employees faced layoffs. The founders walked away. Jenny Qian and Charles Liu faced penalties but no prison time. The money was gone, the company destroyed, and the believers paid the price. First lesson: hypergrowth without profitability is a con. Luckin opened 5 stores per day while losing more than it earned. Real businesses prove unit economics work before scaling. When companies prioritize growth over profits, they're either buying market share with investor money or hiding a broken model. Second, if you can't verify the numbers, walk away. Luckin's app-based model meant nobody could independently confirm sales. No analyst could visit stores and count customers. All data was controlled by management. When verification is impossible, fraud becomes easy. Third, watch what insiders do, not what they say. While founders publicly promoted growth, they were pledging nearly half their stock as collateral for personal loans. That's not confidence. That's cashing out. Founders who believe in long-term value hold shares. Founders who know it's fake extract liquidity before collapse. Fourth, too good to be true always is. Luckin checked every box investors love. Disruptive tech, explosive growth, David versus Goliath. But the valuation required believing they'd achieve in 2 years what took Starbucks decades. When an opportunity seems perfect, that's when skepticism matters most. Luckin Coffee fooled venture capitalists, Wall Street analysts, and institutional investors. They raised hundreds of millions in fraudulent capital. They destroyed $5 billion in market value, and the people responsible walked away with minimal consequences. The insiders cashed out. The employees lost jobs. The investors lost everything. Financial collapse never sleeps. Subscribe so you don't miss the next investigation. Every week, another billion-dollar lie gets exposed. Click the video on screen to see how FTX pulled the exact same con. And if you spotted these red flags before I said them, drop a like.